10 days, and that's all that's left. On February 27th, every trader holding a March silver futures contract on COMEX has to make a decision. Roll it forward, close it out, or stand for delivery. Stand for delivery means you're telling the exchange, I don't want paper, I don't want cash, I want my silver, physical metal in my hands. And for the first time in the history of this exchange, the math doesn't work. There are currently over 400 million ounces of silver tied to March futures contracts. 400 million. And COMEX has 98 million ounces registered for delivery. 98. As of February 11th, registered silver officially dropped below 100 million ounces for the first time. They lost over 3 million ounces in a single day, and it's still draining. At the current rate of 785,000 ounces per day, by February 27th, there may only be 85 million ounces left, 400 million in contracts, 85 million in metal. You don't need to be a mathematician to see the problem. And what I'm about to show you is going to make this math problem look even worse. But here's what most people covering this story are missing. And I'll get to this later in the video. The delivery crisis isn't just about COMEX inventory numbers. It's about what's happening in Shanghai, in London, in the boardrooms of companies like Samsung and Tesla. And when you see the full picture, you'll understand why February 27th might be the most important date in the silver market in 46 years. Stay with me. Let me explain First Notice Day for anyone who's new to this, because understanding the mechanics is critical. COMEX silver futures trade in monthly contracts. 4 of those months are what they call primary delivery months. March is one of them. It's the big one. First Notice Day is when contract holders officially notify the exchange that they intend to take physical delivery of the silver their contract represents. Each contract is 5,000 ounces. So if you hold one contract and you stand for delivery, you're saying, give me 5,000 ounces of real silver. In a normal month, most traders don't do this. They roll their contracts forward to the next month, or they close out their positions and take cash. Maybe 3 to 5% of contracts actually stand for delivery. The system works because the assumption is that almost nobody actually wants the metal. They just want the price exposure. But that assumption is breaking down, and the data proves it. Welcome to the hidden economy. If you're new here, subscribe, drop a like. It really helps the algorithm and keeps me motivated. Thank you. Now let's get into the numbers. January 2026 was not a primary delivery month. It's supposed to be quiet. But COMEX processed 49.4 million ounces of silver deliveries in January. Let me put that in perspective. In January 2024, the number was about 6.8 million ounces. That means January 2026 saw 7 times the delivery volume of January 2024. 7 times. In a minor month. And it wasn't just January. Total COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. Every single month last year saw higher deliveries than the same month in 2024. Every single one. The trend is not slowing down, it's accelerating. And here's the number that should stop you in your tracks. February 2026, which is still ongoing, has already shown a 98% delivery rate. Out of 19.11 million ounces of open interest, 18.72 million ounces were called for delivery, 98%. In a normal functioning futures market, that number should be in single digits. When 98% of contract holders are demanding physical metal, that is not a futures market anymore. That is a physical allocation mechanism. The paper is converting to metal, and the metal is leaving. Now, let me show you what's happening to the inventory, because this is where it gets alarming. In October 2025, COMEX registered silver stood at 167.7 million ounces. By early February 2026, it had fallen to 103.5 million. That's a 38% decline in just over 3 months. But it didn't stop there. On February 11th, a single-day adjustment wiped 3.2 million ounces from the registered category. Total registered silver fell to 98 million ounces, below the psychologically critical 100 million mark. And eligible silver is draining too. Eligible means the metal meets COMEX specifications, but isn't currently available for delivery. It's sitting in the vaults, but it belongs to someone and they haven't offered it up. On the same day registered, dropped below 100 million, eligible stocks lost 4.7 million ounces. That's a combined withdrawal of nearly 8 million ounces in 24 hours from both categories. Since early September, COMEX registered silver has dropped from 200 million ounces to under 100 million, cut in half, in 5 months. And here's what's remarkable. Even on the day of the biggest silver crash in 46 years, January 30th, when silver fell from $121 to $64, even on that day, physical silver still left the COMEX vaults. 3.3 million ounces walked out the door during the worst sell-off in nearly half a century. The paper price crashed. The physical metal kept moving. That tells you everything about the disconnect between the paper market and the physical reality. So what happens on February 27th? March 2026, open interest represents somewhere between 400 and 500 million ounces, depending on which data you use. Let's be conservative and use 400. If 25% of contract holders stand for delivery, that's 100 million ounces. That would wipe out what's left in the registered category. If the delivery intensity matches what we've seen in January and February, where 50 to 70% of contracts are standing, we're talking about 200 to 300 million ounces of demand against 85 to 98 million in supply. And here's the pattern that's changed in the last 2 years. Historically, if 100 contracts were standing at the beginning of a delivery month, by the end of the month, maybe 5 or 10 would still be standing. People would close out, take cash, roll forward. But for the last 2 years, almost every month has seen more contracts standing at the end of the month than at the beginning. That's new. That's never happened before in a sustained pattern like this. It means people who declare for delivery are holding firm. They're not being shaken out. They want the metal. Now, let me tell you what the mainstream isn't covering. Because the COMEX story is only one piece of this. The Shanghai Futures Exchange has been bleeding silver. On February 8th alone, Shanghai shed 31 metric tons. Total Shanghai inventory is now down to 318 metric tons. And there's a billionaire trader named Bian Ximing who has a 450 metric ton naked short position against that inventory, 30,000 contracts, through his brokerage, Shanghai Futures. This is the same guy who made $3 billion riding gold's rally since 2022. He started building silver shorts in the last week of January as silver hit all-time highs. And after the crash, his position was up roughly 2 billion yuan, about $288 million. But here's the part that matters. His short position is 450 metric tons against 318 metric tons in the vault. More contracts than metal. Chinese regulators have reportedly frozen his ability to add to the position. They've exposed the size of it publicly. Some analysts are saying this sets up a short squeeze similar to the nickel squeeze of 2022. Because if the market turns against him and he can't add to his shorts, the covering could send silver parabolic on the Shanghai exchange. And Shanghai's depletion didn't happen in a vacuum. A large portion of Shanghai's silver inventory was shipped to London in October 2025 to bail out the LBMA during its own delivery crisis. That inventory has never been replaced. The global silver market has split into 3 islands. North America centered on COMEX, Europe centered on London, and Asia centered on Shanghai and India. Each region is fighting over whatever physical metal it can control, and the metal is flowing east. It has been for years. But now the flow is accelerating because China controls 70% of global refined silver supply, and on January 1st, 2026, they added silver to their export control protocols. Think about what that means. The country that refines the most silver in the world just made it harder to get silver out. And the country that consumes the most silver outside of China, which is the United States, just classified silver as a critical mineral and started allocating billions for stockpiling. 2 superpowers, same metal, both trying to secure supply, and the exchange, sitting in the middle, COMEX, has 98 million ounces. Now, I need to talk about what happened on January 30th, because it directly connects to what's coming on February 27th. Silver hit an all-time high of $121 on January 29th. The next day it crashed to 64, a 47% wipeout in hours. Treasury Secretary Scott Bessent publicly blamed Chinese traders, called it a speculative blow-off. But look at what actually happened. The CME Group hiked margin requirements twice in 4 days. They switched from fixed dollar margins to percentage-based, 9% of contract value. That means as silver rose, margins rose automatically. It became a self-reinforcing liquidation machine. Higher prices meant higher margin calls, meant more forced selling, meant lower prices. It was designed to break the rally, and it worked. But here's what the Treasury Secretary didn't mention. On the exact bottom of the crash, January 30th, JP Morgan stood for delivery of 633 contracts. That's 3.165 million ounces, at a settlement price of $78. The bank that paid a $920 million fine in 2020 for manipulating precious metals markets was taking maximum delivery at the exact moment of maximum panic. And here's the technical detail that exposes the mechanics. Silver's implied volatility index fell 10.6% on January 30th. During a 20% crash, that's backwards. In a real panic, implied volatility explodes. Traders rush to buy protection. When implied vol falls during a crash, it signals coordinated position unwinding, not organic fear. Engineered liquidation. China responded very differently than the US. China suspended 5 commodity funds, including their only public silver futures fund. They shut down 6 trading entities. They reprimanded 249 traders for naked short-selling activity. They took real regulatory action against manipulation. The US CFTC said nothing. Now, why does all of this matter for February 27th? Because the crash didn't fix the supply problem. The paper price went from 121 to 64, but the physical metal kept leaving the vaults, the inventory kept draining, the delivery requests kept coming. January saw 7 times the normal delivery volume. February is running at 98% delivery rate, and March is a primary delivery month with 4 to 500 million ounces of open interest. The crash was supposed to scare people out of demanding delivery. It didn't work, and that's what makes February 27th different from any first notice day in history. The market has already been through the worst crash in 46 years, and the physical demand actually intensified. Let me tell you what else is happening that nobody is talking about. Samsung just locked up an entire silver mine. Through a subsidiary, Samsung provided a $7 million prepayment facility to Silver Storm Mining to restart the La Parilla mine in Mexico. The contract gives Samsung exclusive rights to purchase 100% of the mine's silver output for 2 years. They didn't go to COMEX. They didn't buy futures. They went directly to the source and locked it up. That's not trading. That's resource warfare. And Samsung isn't alone. Tech companies across the board are securing physical silver through direct deals, bypassing exchanges entirely, because they understand that the exchange system may not be able to deliver what they need. When corporations start going around the exchange to secure metal directly from mines, that tells you the exchange is no longer trusted as a reliable source of supply. London lease rates spiked to 34.9% in October 2025, with intraday peaks hitting 39%. A lease rate of 39% means someone was willing to pay 39% annualized just to borrow silver temporarily. That's desperation. That's a market screaming that physical metal is not available at any reasonable cost. And after the January crash, while everyone was panicking about the price drop, SLV recorded over 1,000 tons of inflows in a single day, one of the 3 largest single-day inflows in the ETF's history, at the exact bottom. Institutional money didn't panic, it bought. The bid wasn't broken, it relocated lower. So here's my assessment. The COMEX is facing a delivery month unlike anything in its history. The registered inventory has been cut in half since September. The delivery rate in February is running at 98%. Open interest for March dwarfs available supply by a factor of 4 to 5. The 2-year pattern shows contract holders are increasingly standing firm rather than rolling, and the external pressure is only building. China restricting exports, US government stockpiling, Samsung locking up mines, Shanghai inventory at bare bones, London lease rates at historic levels. Now, I need to be balanced here because that's what we do on this channel. And let me be very clear about something. I am not predicting a COMEX default. What I am telling you is that the data is showing stress levels in the silver delivery system that we have never seen before. Not in 2020, not in 2011, not ever. And what happens on February 27th will tell us whether this system can hold, or whether the cracks become fractures. There's a counter-argument. Some analysts point out that open interest is not the same as delivery demand. They're right. Open interest includes both longs and shorts. Most contracts have always been settled without physical delivery. The system works on the assumption that only a small fraction will actually stand. And historically, that's been true. The question is whether February 27th breaks that pattern, whether enough contract holders look at the inventory numbers and decide, I need to get in line now. Because if 100 million ounces stand for delivery and there's 85 million in the vault, it becomes a first-come, first-served situation. And nobody wants to be last. The nickel market showed us what happens when delivery claims exceed inventory. In 2022, nickel quadrupled in 48 hours when it turned out inventories had been sold multiple times. The exchange canceled all trades from those 2 days, just erased them, pretended they never happened. Billions of dollars in legitimate profits were wiped out with a keystroke, and almost nobody faced consequences. If something similar happens in silver, the implications would be orders of magnitude larger, because silver isn't just a traded commodity. It's embedded in every major technology of the 21st century: solar panels, electric vehicles, semiconductors, military hardware, medical equipment, 5G infrastructure, AI data centers. A nickel default was a problem. A silver default would be a systemic crisis. And here's something that most people in this market don't fully understand. If COMEX or any major exchange hits a real failure to deliver event, it doesn't just affect the futures market, it triggers a credit event. Derivatives are a closed game. For every winner, there's a loser. And if the loser can't pay because the exchange changed the rules or canceled the trades, the winner doesn't get paid either. Banks who are on the losing side of these trades, and we know from CFTC data that banks collectively held over 200 million ounces net short as of early December 2025, those banks need the system to hold. If it doesn't, the losses cascade through the entire derivatives chain. And that brings me to something that nobody wants to talk about, but everybody needs to hear. The legal framework for what happens when a major financial institution fails has been completely rewritten in the last decade. Your brokerage account, your 401k, your assets held at any financial institution, they're legally not yours. You are a beneficiary. The institution is the legal owner. If that institution gets into trouble under current law, they can use your assets to save themselves. It's called a bail-in. Some people call it the Great Taking, and the laws that enable it are already on the books. You can sue, but you'll lose, because the legal structure was specifically designed to give institutions priority over retail investors in a crisis. I'm not saying this to scare you. I'm saying this because if you have 100% of your wealth inside the financial system, inside brokerages, inside banks, inside institutions that are counterparties to silver derivatives, then you need to understand what the worst case scenario actually looks like. And the worst case scenario starts with a delivery failure. And there's another option that COMEX has, force majeure. They can declare that extraordinary circumstances prevent them from making delivery and settle contracts in cash instead of metal. The contract allows for it. But if they do that, it's an admission that the silver futures market cannot deliver silver, that the paper and the physical have permanently divorced, and every industrial user, every central bank, every government stockpiler would immediately accelerate their efforts to secure physical metal outside the exchange system. A force majeure wouldn't end the crisis. It would intensify it. Now, let me tell you about the timing of all of this, because the timing is not random. We're in the middle of Chinese New Year right now. Chinese markets are closed for the holiday. That means the physical buying pressure from Shanghai, which has been the dominant force in the silver market for the past year, is temporarily offline. And historically, when China is closed, Western exchanges take the opportunity to move prices. The pattern is well documented. When the physical buyers step away, the paper sellers step in. So here's what I expect. Possible downward pressure on silver this week while China is closed. Maybe significant, maybe not. But when Chinese markets reopen and we go straight into February 27th, first notice day, the physical demand comes rushing back at the exact moment contract holders have to declare their intentions. It's a collision course. Paper sellers who use the holiday to press prices lower, meeting physical buyers who come back and see cheaper silver with even less inventory than when they left. And consider what happened after the last crash. China didn't just sit there. They took action. They suspended 5 commodity funds. They shut down entities engaged in naked short selling. They reprimanded hundreds of traders. That's a government that is protecting its access to physical silver, a government that understands the strategic importance of this metal. When Chinese markets reopen after the holiday, do you think the government is going to let its citizens miss an opportunity to buy silver at discount prices while COMEX inventory is at its lowest level in history? I don't think so. And there's one more piece of this puzzle that ties into the bigger picture. The BRICS nations have been working on an alternative settlement currency backed partially by gold and other commodities. The target date for the unit, as they're calling it, is mid-2027. If a major commodity exchange like COMEX experiences a delivery failure or a force majeure in silver, it accelerates the narrative that Western financial infrastructure can't be trusted. That paper contracts backed by Western institutions aren't worth the paper they're printed on. A COMEX silver crisis would hand the BRICS exactly the ammunition they need to say, see, this is why you need a currency backed by something real. The world uses 40 to 50 million ounces more silver per month than is actually produced. That's the deficit. And it's been running for 5 consecutive years now. Total cumulative shortfall since 2021 is estimated at 820 million ounces. Nearly a full year of mine production. Where did those missing ounces come from? Exchange vaults, bank holdings, private hoards. They've been drawn down systematically, and now the buffer is almost gone. And here's what I find most telling. New mine supply won't save this. Even if every silver exploration project got approved tomorrow, the development timeline for a new mine is 7 to 10 years. That means the high prices of 2026 will not translate into new supply until at least 2033 to 2036. For the next 7 years, the supply curve is essentially locked. So let me connect this back to what we talked about in the last video. The 11,000 contracts betting gold goes to 20,000 by December. If gold triples under yield curve control and silver's gold ratio compresses to its historical mean, silver goes to 300, 400. And the COMEX can't deliver at 77. What happens at 300? The industry already broke at 121. Refiners locked up. Dealers froze. Wholesalers ran out of capital. The financial infrastructure couldn't handle the velocity of the move. Now imagine that happening at 200, 300, with less inventory, with China restricting exports, with the US government competing for supply, with Samsung locking up mines. Here's what I think is happening. I think the smart money already knows that the paper silver market is on borrowed time. That's why delivery volumes are exploding. That's why Samsung is going directly to mines. That's why Shanghai inventory is collapsing. That's why lease rates are at historic levels. That's why the crash didn't slow the physical demand. The smart money isn't trading silver anymore. They're securing it. And Wall Street is starting to say the quiet part out loud. Citigroup published a note saying Chinese retail investors are trend following and that strong buying will continue due to strong short-term momentum. Their target? $150 in 3 months. That's Citigroup, one of the largest banks in the world, saying silver goes to $150. And that was before registered inventory broke below 100 million. And there's a historical precedent that everyone in this market should know about. In 1980, when the Hunt brothers were cornering the silver market, the exchanges didn't just raise margins. They introduced what became known as Silver Rule 7. They literally changed the rules so that the exchange would only accept sell orders. No buy orders allowed. They turned it into a one-way market, forced the price down by making it illegal to bid. They've done it before. And the current margin hikes, the percentage-based calculations, the coordinated fund suspensions in China, they're the modern version of the same playbook. Change the rules to protect the short side. But here's the difference. In 1980, there was no Shanghai exchange competing for price discovery. There was no China controlling 70% of refined supply. There was no critical mineral designation. There was no government stockpiling program. The rule changes worked in 1980 because there was no alternative market. Today there is, and the alternative market is buying every ounce it can get. And I think February 27th is the next test, not necessarily the final one. COMEX has survived stress before. They'll raise margins. They'll change rules. They'll do whatever it takes to prevent a formal default because the consequences of a default would ripple through every commodity market on the planet. But each time they intervene, the credibility of the paper market erodes a little more, and more metal flows east. More companies go direct to source. More investors demand an allocated physical. The paper game is getting harder to play, not because of any one event, but because the math is getting worse every month. More contracts standing, less metal in the vault, more industrial demand, more government stockpiling, more export restrictions. The trend lines are converging, and they converge on a day like February 27th. This is my opinion, not financial advice. Do your own research, make your own decisions. But the data is the data. 98 million ounces registered, 400 million plus in March open interest. 98% February delivery rate, 7 times the normal January delivery volume. Inventory cut in half since September. Shanghai at 318 metric tons. China restricting exports. Samsung locking up mines. US government stockpiling. Lease rates elevated. Supply deficit in its 6th year. And 10 days until first notice. The physical market is speaking, louder than it has in 46 years. The paper market is trying to shout over it. And in 10 days, we find out which one wins. The clock is ticking. February 27th, market. Drop a comment and tell me, do you think COMEX makes it through March? Physical silver, miners, or futures? I want to hear your take. I'll pin the best responses. Share this video with one person who owns silver. Most people have no idea what's about to happen on February 27th. Most people don't know that registered inventory just broke below 100 million. Help me get this information out. If you're not subscribed, hit that button now. The Bloomberg memo, the Russia deal, the China crackdown, the corruption data, the $20,000 gold bets, the silver stockpile, and now the delivery crisis. I'm connecting dots that nobody else on YouTube is connecting every day. With data, sources, and analysis you won't find anywhere else. This is the hidden economy. Stay sharp, stay stacking, and I'll see you soon.